Hello and welcome to Macro Mondays. Our regular host James Brody is not with us today. He's currently on business in Singapore. I'm Harry Nedeljkovic, a research analyst here at Onyx Capital Group, and I'm joined by Harry Tchilinguirian, our head of research.
Hi, Harry.
We have a lot to talk about this week, as normal. We have Chinese industrial production and retail sales data, also the same for the US. We have US housing starts as well, building permit stats, as well as UK CPI data, retail sales data, and PMI data for June. In addition, in terms of central banks, we have news about the Swiss National Bank and the Bank of England's policy rate decisions. We've also got some Euro area PMI preliminary stats for June. And I'm also going to give an update on the French elections. We also go into a little bit after that. I've got a bit on demographics, and Harry's going to talk about potential trade idea.
So maybe we should start kicking it off and start looking a little bit at the Chinese data. Certainly when it comes to industrial production, we've seen a slowdown, at least in the rate of growth, printing for May at 5.6%. On the retail side, we had a beat in terms of the figures we got. Retail sales were up 3.7%. And this is certainly interesting in terms of the overall outlook for China and whether or not industrial output is going to be able to recover. Now, the National Bureau of Statistics sounded a little bit of a cautionary note, Harry, in terms of how industrial production may evolve in the context of what's driving exports. And, clearly trade wars that we mentioned last week could be an issue. But in the short term, I would expect exports to remain relatively resilient in the second half. There's the ongoing semiconductor cycle. We're looking at restocking activities in developed economies should there be trade wars. So hopeful that IP in China doesn't slow down more. And if it does, obviously, that's certainly in terms of a number of markets going to have repercussions, right?
Mm. When it's such a big market that's essentially been driving growth for so long.
Yeah.
Any sort of slowdown is just going to ripple out to.
No, and in terms of other Chinese data, obviously we look at fixed asset investment. Not much of a strong read there. More importantly, perhaps, we're looking at the property sector. As we know, the property sector is another big component of China's GDP, and that property sector continues to ail. And in this particular chart that we're looking at investment year to date, and is down by 10%. So again, the sort of economic resurgence of China is still unwanting. It's tough to say whether or not all the stimulus measures that were taken will eventually filter through. But when you do have that industrial production and property sector that are ailing, it's not particularly good news in my view.
No, I agree. I think especially given, it's still the world's biggest asset class, I believe. China's real estate sector. Yeah. It's just outrageous. And yet in addition to that, just with an increasing amount of empty properties, especially as China's population starts to go down, who knows what's going to happen with...
Certainly, yeah, that's an interesting point between longer term demographic trends and overcapacity, oversupply in the sector, how you're going to reconcile both. And especially an unwillingness right now from the Chinese consumer to either lend or necessarily go into property, given sentiment perhaps is not just quite there yet.
Also,
well, we could shifting on to the complete opposite side of the world, looking at the U.S. We have the flip side of China, whereas in China we saw industrial production growth slowing down and retail sales experiencing a beat. In the U.S., it's kind of the opposite picture. It's industrial production rose 0.9% in May. So in terms of the hard data, that's pretty good. It was a pretty broad-based pickup in factory output. And so that's probably a good sign in terms of the manufacturing sector. The hard data we're having here in May sort of contrasts with the PMI data given by the Institute of Supply Management. Those were maybe a little less favorable in terms of the contraction expansion reading. But in the meantime, just in terms of hard data, we have a strong rebound in terms of IP in May. And that's coming off a downwardly revised previous month. So all in all, we're hoping that the industrial production in the U.S. is back on a more solid footing. and we'll just have to wait for the next print to see if that is the case. Now, obviously, industrial production is important, manufacturing is important, but one of those indicators that people love looking at is the housing market, and here things are not as bright as what the IP would have suggested in terms of outlook. So the U.S. housing sector is slumping. Housing starts were down 5.5% month on month in May. Building permits, so future construction of houses or applications for future construction for houses, down 3.8% on the month. So, I mean, we're looking at new home construction in the U.S. in May, probably the slowest pace in 4 years, I'd say, something like that, while permits fell to their lowest level since June. Obviously, there are multiple reasons, but in terms of the lackluster trends in U.S. housing, part of that was obviously a Fed keeping interest rates higher for longer. So whether it's borrowing costs or just financing in terms of the general public, but it's not particularly a supportive factor. So having that weakness in the housing market, and I mean, we look at that because there's a lot of derived demand. So whenever the housing market picks up, obviously that generates demand in a variety of sectors. So this is certainly less promising in terms of the macro picture that we got from the U.S. last week.
I was going to say, I find it interesting that despite sales slipping, prices, so median home prices are at median home prices for May were $419,300, which were at their record levels, at least since 1999, so 25 years.
Yeah.
Really just, do you see that as a bit of a disconnect?
Yeah, somewhat. I think there's going to have to be a correction in terms of pricing. Perhaps, that may happen a little bit earlier than when the Fed eventually cuts rates. We'll see. But while the Fed is on higher for longer right now, and you have such a high home price, then the slump that we see in terms of, especially new permits, I mean, that's at the end of the day, permits is what points to future construction. So the sector may not be so enthusiastic in actually going in there, applying for permits when they don't have confronting them a strong demand on the other side. So, but in terms of the macro data in the U.S., manufacturing better. However, one of the key sectors of the economy not doing so well, and as you rightly pointed out, I think consumers are still going to be reticent at these prices and at these borrowing costs to go in there.
It'll be interesting to see if that has any election implications as well. We're about 4 months out, 4.5 months out.
Yeah, we are, and something we I guess we'll obviously mention again at the end of this show is we're going to have our first presidential debate on Thursday.
We are indeed.
So how each of the candidates is going to put out meaningful themes, whether it's border and immigration, the broader economy, and whether or not in the context of inflation that will obviously be hotly debated, whether the housing price is going to come into the picture, and if one or the other of the candidates is going to say something about that, we'll see.
I imagine it will also be the oldest combined age of a presidential debate, breaking their own record.
Yeah.
Almost by a long way. Moving on. So UK inflation also came in fairly positive in the past week. So UK CPI returned to the Bank of England's target of 2% year on year in May. So the UK, the Bank of England always has a 2% target, and then the Bank of England's governor has to essentially write a letter if it goes more than 1% above or below that, explaining why. So finally he's got on that. They've managed to get inflation back to 2%. It's really, really welcome news. Inflation in the service sector has been persisting. Essentially, like energy prices are still very high. And in the May meeting, the Bank of England pointed to services inflation as the sort of key barometer of inflation persistence. The inflation sort of still above what the Bank of England would like, and obviously they still haven't cut rates. It's unlikely they're going to cut rates prior to the election. They could have done, but essentially given the potential political ramifications, they tend to not like to do that. And also UK retail sales came in particularly strong, also stronger than expected. So they were expected to rise by 1.8%, but they actually increased by 2.9% in May. Increase in volume of goods sold was very broad and reversed a really poor April reading. Some people had that down to poor weather, and May sort of finally started to see weather get better. And essentially, yeah, just an unexpectedly positive bit of macro data from the UK.
Yeah, perhaps the poor weather conditions in May prevented some people from going and hitting the high streets and buying, well, whatever it is that they wanted to buy. The rebound is certainly interesting. I mean, it's a good print, and I would say that if people are looking to an easing in financial conditions in the UK, when that comes about, there is good momentum here in terms of the sales data, retail sales data going forward. It's going to be a tricky one, especially in the context of sticky inflation for the Bank of England. We have a decent consumer reading, but we still have stickiness in the services sector. How the Bank of England is going to juxtapose both of them, again, in the context of how employment is evolving as well, is going to be interesting. But as we'll see later on, all of this does not seem to preclude that the Bank of England will be moving now that it is or has achieved its inflation target. And if it does remain at that level on the next print, then there is, I think, a strong impetus for the BOE to act.
Absolutely. And then moving on to Eurozone PMI.
So yeah, I guess crossing the channel to the continent, we have PMI data for the Eurozone as a whole, and we also had preliminary data for France and Germany. So Eurozone in general, composite PMI was down to 50.8. So still in expansionary territory above 50. But the index came in lower than the previous reading. And then when we start looking at the preliminary data for the two powerhouses of the continent, France and Germany, the readings are not particularly good for France, and composite is contracting with a print of 48.2. Germany was doing better, but obviously still in expansionary territory, but slowing down. So this developments on the continent contrast with those of the UK. I think the UK PMI were pretty much positive. The composite index was up to 51.4, and I think services printed 51.2. So it's decent readings in terms of PMI for the UK, not so much for the big economies of Europe and Europe as a whole. And I think, if we turn to the next slide, we get a better read on manufacturing in particular. And this is really, I think, the sore point for Europe, whether it's France or whether it's Germany. I mean, France's manufacturing came down to 45.3 on the print. Germany's manufacturing 43.4. And when you look at the chart of the, in terms of evolution of the PMI for manufacturing, whether it be the Eurozone or these two countries, I mean, we've been looking at readings below the 50 mark showing contraction ever since, well, when
essentially was it? 2 years now. 2
years running, yeah. So it's going to be difficult to see, how that's going to improve, especially in light of today's release of Germany's IFO Business Climate Index. Now, all categories of the IFO survey came below expectations. The business climate figure coming in at 88.6 versus 89.3 in June. So I think there's still going to be some persistence at least in this sector of the economy for the Eurozone. And it's not looking particularly upbeat.
It's just been essentially since Germany hasn't been able to, or has had to scale down its consumption of cheap Russian gas, they just can't seem to find a way to, replicate the sort of manufacturing levels they had a couple of years ago. But I really struggle to see where they're going to get that growth from.
Yeah. And if we look at France and Germany, I think what Germany still has going for it is a service sector that's still relatively resilient. I mean, the service sector for the preliminary June data was printing above 50 at 53.5. The picture is a little bit more dire in France, where you're looking at both manufacturing and services below the 50 mark. So this, in the context of elections coming up in France, is not particularly good news for the current incumbent governing party, right?
I think just to finally add something about manufacturing, especially something to really watch in the next couple of years, I think will be essentially like German automobile exports have been such a massive part of their budget surplus, everything to do with that. And if China is no longer a market that's going to import increasingly electric cars, where are they going to export to? Can they find other markets?
Yeah, it's a very interesting thought, in the sense that there is overcapacity in EVs in China, and obviously they're compared to the price of EVs, and we had touched upon this in other podcasts, where you're definitely looking at a European and a US auto sector that's not competitive relative to what China is doing. So then after that, if China itself and its domestic agenda pushes, if they can't push out the exports to Europe or the US as a result of trade restrictions, and they push more aggressively, EVs in their own domestic markets, you could think about Germany obviously exporting a lot of automobiles to China. Whether or not there is going to be a slowdown there. Again, the categories of vehicles, of course, are important, because when you're looking at exporting, BMWs, Mercedes, it's a little bit different category in terms of the final consumer who buys it. But
that sort of luxury mark.
Luxury segment, yeah. It's thing with luxury. It's always difficult to say how it's generally impacted by the general climate. It always ends up ending up relatively resilient, even if you have weaker economic conditions elsewhere.
Definitely. And so an update on the French election, the upcoming French election, which is now this week on the 30th, which I believe is Saturday. Only for the first round, of course. As a sort of guide to the polls at the moment, so Marine Le Pen's national rally, they're on about 35%, and they're forecast to be the first round winners. And the NFP left-wing alliance is forecast to be around, this says 26%, but I've seen it go between sort of 26 and 29, 30%. Ensemble, which is Macron's coalition, is only forecast to be on around 21%. So really, his polls have gone up slightly since he called the election, but still sort of nowhere near what he'd need to get even approaching a majority. He might get about 100 seats of the 589. As a sort of reason for why markets have been so spooked by the prospect of either the National Rally or the NFP getting in, both have massively increased spending forecasts. So the NFP, one of their pledges is to immediately raise taxes by 50 billion euros a year, along with an additional 106 billion by 2027. So this would be through raising income tax, reintroducing a wealth tax, capping inheritances, increasing the minimum wage to 1,600 euros a month, in addition to cutting the retirement age to 62, which especially in the context of France, I'm sure people are aware of the huge protests that happened when Macron raised the retirement age. This would really be a recommitment to increase public spending. And Rassemblement National would essentially be doing the same thing, but through different methods, just massively increase public spending and increase taxes to...
Well, that's, it's quite interesting how, I guess, each of the parties, left and right of center, have an agenda that is going to greatly increase spending, and therefore the question is, how are you going to pay for it, and how do you finance it? France's national debt, I think, currently stands at 9.95 trillion.
2.95 trillion.
2.595 trillion.
Yeah.
That's 112% of GDP or something like that. And so obviously people are going to be paying a lot of attention in terms of these spending plans and how they're going to be financed, because the question is, are you going to be going into further debt, or are you going to be taxing where, and whether or not that's going to actually be feasible, and what economic implications those tax rates may have in terms of activity and spending. Mm-hmm. So extremely interesting to see what we're going to get. And I mean, I think a lot of people are talking about election results with a hung parliament. So that could obviously cause a number of issues from a sentiment perspective.
Absolutely.
Whether we get a Rassemblement National government with maybe the support of the center-right or part of the center-right. But it looks like one of the more distinct possibilities.
I find it just a really interesting trend that you see from other predominantly Western governments, but it's this, well, I mean, in France's case particularly, a budget deficit of under 5% is seen as a sort of achievement. When 20 years ago, that was unheard of. If you have a deficit that big, it's just, it's not feasible. Even the most fiscally responsible party, you could argue in a variety of ways whether that's what you describe Ensemble as, but they aim to get France's deficit below 3% by 2027. And that's seen as like the absolute best case scenario. And
3% was basically the fiscal prudence guideline that used to exist, that obviously went out through the door with COVID. And then Macron's government spared no efforts in terms of sustaining the economy through those difficult times. And then spending did indeed increase quite substantially. So reverting to a 3% target is obviously commendable. But when you start looking at the reality of the situation, then as you said, achieving below 5% almost becomes a victory.
It's just when you get used to the near zero interest rates, it seems like we still can't get off those. And as a sort of implication of the uncertainty around the French election and essentially the increased national debt, increased spending, France's 10-year yields now they still exceed Germany's by more than 75 basis points. So essentially, given who the market believes will be in a significantly powerful position, be it the right wing or the left wing, the market isn't particularly happy with that. Traders and essentially market participants do not feel confident that France will be in a good fiscal place after the election. Back to you, Harry.
So I guess what does this all mean in terms of central banks going forward, right? So as usual, we have a look at what the market's pricing in based on the overnight interest rate swaps. And interestingly enough, for the Fed, as of this morning, for the end of the year, the market is pricing in almost 2 rate cuts. And so the market being a little bit more optimistic than the Fed dot plot, because the median of the dot plot implied only 1 rate cut before the end of this year. Perhaps the market is looking at inflation coming down a little bit faster, maybe the economy proving resilient. I don't think the Fed is in a rush, really, to be bringing down rates. Last Macro Monday, we talked about, is 2%. I think it is, but it's interesting to see that the market is pricing in 45 basis points of cut, so nearly 2 times 25. ECB, they already cut rates once. Market is looking there at also another more dovish approach to policy. Maybe not as strong as what they're pricing in for the Fed, but we got 43 basis points. So last week, we mentioned this. I mean, the Bank of England was basically kept put. And I think a lot of that has to do with the fact of not doing anything over the course of an electoral cycle, and probably ready to move in August, most likely, when it comes to the first rate cut. Interestingly enough, the Swiss National Bank, they cut rates. And there was nothing really, at least in my mind, economically to motivate the cut in rates by the SNB. So they cut 25 basis points and the policy rate's down at 125%. At the end of the day, I mean, is it an exchange rate issue rather than an economic issue? They don't want the Swiss franc to appreciate too much. In the past, the Swiss National Bank has been known for even intervention in currency markets to avoid the Swiss franc appreciating too much. It may be a case there that given the uncertainty that obviously in the US, in Europe, that you could be looking at the Swiss franc as a safe haven. So the Swiss franc gets bid up above and beyond what the central bank would like. So here the market's pricing in before year end another rate cut. It's quite possible that, in my view, the SNB actually does that. Again, with a view of managing the exchange rate rather than necessarily addressing underlying economic problems.
I think, yeah, and obviously, as you can see as well, the Bank of Japan are still planning just a one increase.
Yeah.
The yen weakened to its lowest level in 30 years. So it's almost hit 160 to the dollar. Just no sign of it
Abating, yeah.
yeah, no sign of it strengthening. Still crazy that the Bank of Japan can only increase by that much, given the sort of hole that they've
dug themselves into. Yeah.
Yeah.
So returning to equity markets, just sort of recapping a little bit of what we said last week. The S&P is still on an upward trend, even though in the latest data I corrected down a little bit. But if you look at the chart we're showing, I mean, in orange there, you have the S&P 500 still progressing nicely. And at the same time, we're looking at, the percentage breakdown of companies that are at their 52-week highs versus the number of companies that are at their 52-week lows. So the ones near the lows have shrunk a little bit, and we've had further declines in the share of stocks that were actually at their 52-week highs. So breadth shrinking maybe a little bit, but nonetheless, there's no grounds yet really there to say that the S&P is in for a massive correction.
Nothing yet.
Nothing yet, as you say. So we're going to be focusing on tech, right? Once more.
We are. I feel like it's very hard to ignore, especially when you're talking about the S&P in the US. So big sort of story about tech last week was Nvidia became the largest company in the world by market cap. I think it topped out at about $3.35 trillion. Just, incredible. When you compare it to any other stock market, it's miles ahead. I believe Nvidia its market cap became higher than that of all UK stocks.
That's just possible.
FTSE stocks, crazy. Essentially, yeah, due to chip demand related to AI, Nvidia's still been just flying.
I think what's remarkable in the chart that we have comparing Nvidia to Microsoft and Apple, I mean, those two behemoths, and suddenly Nvidia, a chip maker, has a market cap that is exceeding both those companies. And when you sort of look at the path of prices, I mean, I heard many people commenting on this in the near exponential growth in terms of the price of the stock. Is this, raising concerns around technology and that are reminiscent of the dot-com bubble? I mean, is Nvidia gonna basically keep pricing at these levels, if not increase? This time around, is it different because of AI? It's hard to say, right?
We just don't know.
No.
We haven't seen AI's uses. We haven't seen that in regular consumer products yet. Definitely not the full extent.
Mm-hmm. I think even businesses sometimes have difficulties in terms of the deployment of AI and where to use it. So, but it's certainly, I think, at the forefront of basically how these stocks are pricing. So, of course, in terms of AI, Apple has also come out with its Apple Intelligence. Microsoft has things like Copilot. Then at the end of the day, I think part of one way I suppose we could try to see or gauge whether this is something that's sustainable is start looking at all the related equities to that artificial intelligence landscape. And so Nvidia is making the chips, but you need to put these chips in servers. Like we see the stock of Dell going up, but I think you have a more interesting chart in terms of that sort of ecosystem or broader ecosystem.
Fascinating company, ASML. So it's Europe's biggest tech company by far currently, hit all-time highs in the past few weeks. The really sort of interesting thing about this, it's so uncommon for Europe now. They produce advanced photolithography machines, and they are the sole global supplier of extreme ultraviolet lithography, photolithography machines that are required to manufacture the world's most advanced chips.
They're in a world of their own. I mean, literally,
they really are.
I don't think they have any real competition.
They don't, and hence why the US is currently pushing to prevent ASML from exporting to China by virtually any means necessary. And it makes it even more sort of spectacular given, so I mean, as we've discussed, the US alone has 3 tech companies worth over $3 trillion. They have quite a few others worth 1 trillion plus, be it something like Amazon, and then again, far more over 100 billion, 500 billion, that sort of range. In Europe, including the EU, UK, and Switzerland, there are only 3 tech companies worth over 100 billion, 5 worth over 50 billion, and only 12 are in the world's top 100, of which 5 are Dutch. ASML is one of those. But the disparity is just huge. And ASML, I'd really say, is the only European tech company that can offer the same sort of growth or the same sort of relevance to the global market as the US companies.
I think we could also probably add that, in terms of gauging the sustainability of an Nvidia and the whole AI implications, we talked about where these chips eventually have to end up. They have to end up in servers. So you could see the likes of Dell obviously benefiting ASML. It produces the machines that helps make these chips. But I think even other semiconductor manufacturers, such as Taiwan Semiconductors, they're also doing pretty well in this broader sort of AI-driven landscape.
I think, we wouldn't be surprised if their market cap exceeds $1 trillion at some point in the next couple of weeks, months, if their growth continues.
So I think we're switching tack completely here, and we're leaving the equity markets for some interesting developments when it comes to demographics. And I think you singled out South Korea, and this is particularly a telling story in the broader context of even other Asian countries that face demographic challenges.
Indeed, we are.
China and Japan as well. But what's happening in Korea?
So essentially, Korea is the most extreme example of the current decline in fertility rates. So virtually every country in the Western world, apart from, actually not even a country, but the Faroe Islands, I believe, are the only territory/country in what we call the Western world that have a fertility rate of above 2.1. So that's the replacement rate required to essentially keep a stable population going into the future. So you have 2 kids who have 2 kids themselves, carries on like that. Korea's is 0.72, or their last recorded figure in 2023. The news this week was that the president declared a demographic national emergency. So the country's already spent $300 billion on fertility-raising initiatives over the past 20 years to encourage young couples to have families. It hasn't worked at all. It's really hard to overstate the effect of this. So Korea's population started declining a couple of years ago. Its population likely will never hit the levels it was as long as both of us are alive. It's just
quite likely.
Really crazy. So with every generation, essentially, like once the current generation dies and then replaced by the next one, the population will divide by 3. So if you think of that as 3 generations time, it would be the current population is 51 million. That would literally go down to single-digit millions. So the effect of that, and that could really be in 100 years, maybe only slightly more than that. Just crazy. A whole restructuring of the global economy, whole restructuring of how pensions work, of how governments essentially provide services if there are virtually no working age people versus dependent over 65s. Just a huge trend that I think is only going to be discussed more and more.
Well, I think, what's quite interesting because we're mentioning that demographic challenges in terms of aging populations, lower fertility rates in a number of key Asian economies, Japan, China, and obviously we're highlighting South Korea. at the end of the day, there's going to be obviously, I think, a big change in immigration flows, because they will need to bring in labor from neighboring countries. Whether it's something that they are ready, prepared to do, is something else.
Yeah.
But I think it will be interesting in terms of at least regional migration patterns of population from maybe faster growing demographic areas in let's say Southeast Central Asia. Where are you going to get that labor from to, one, support the elderly, and two, keep running the economy?
The interesting thing with especially like Korea, Japan, China is they have extremely low levels of international migration. Maybe those will pick up. I think there are signs of that happening in Japan especially. But the issue is, given this is a worldwide phenomenon, it's really hard to see eventually where immigrants will come from, because this will affect everywhere in the world. And you can't you can take people from other countries, but then the problem isn't actually, if you see it as a problem, it's a problem that won't be solved.
Or at least with immense difficulty.
Exactly. And currently, there are no real strategies in place, or there's no policy that's found to actually be successful to significantly raise a country's fertility rate for a variety of reasons. That would take far longer than a brief Monday podcast to go fully
discuss,
into. Back to commodities.
So commodities, we thought we'd talk about these this week, and so we're putting up a chart here. What this is a BCom commodity sector indices, and they're essentially normalized to 100 from the beginning of the year, just to see a little bit how the sectors of the commodity sectors of the BCom index behaved. Well, since the beginning of the year, obviously very poor performance in the red line in agriculture. Looking at returns year to date in the energy sector, relatively resilient and holding up. And I think what the most interesting is that despite the run up that we had in May, in particular, when it came to metals, be it base metals or precious metals, some of the shine of that, no pun intended, has come off, and that's particularly true of industrial metals, where even though, on the year, it's still showing pretty good progression, but we certainly have dropped back a little bit. And does that have to do with, especially when it comes to industrial metals, a lot of the demand growth is driven by the economies of China and others, but I mean, China remains always a central issue when it comes to industrial commodity demand. And as we saw earlier in our chat, you look at industrial production, it's not looking particularly good. Obviously, it may see some resilience because people are restocking up ahead of potential tariffs. The semiconductor cycle is still happening, but I don't know. This is certainly an interesting reversal in terms of performance. So, not to be too negative about it, when we normalize to the beginning of the year, the industrial commodities sub-index of the BCom, basically the Bloomberg Commodity Index, has retraced, whereas precious metals, bit of retracement, but holding up a little bit better. So
I think you could probably say, at least from a consumer's perspective, if the trend seen in May in metals had continued, it'd be pretty scary to think if the most essential metals are going up by potentially 40-50% year on year, what happens to inflation? What happens to supply chains?
Well, it's always it's sort of difficult to translate the pass through from the commodity price into the final manufactured good, because in terms of the share of the commodity price in the final good is up against costs of labor, the cost of running the plant, et cetera, et cetera. But nonetheless, whether it be construction, manufactured goods, still a decent progression. I think if we stick to the energy sector and the industrial metal sector, we're looking at a chart here that, again, it's a mono index from the BCom for both Brent and copper. And you're seeing Brent in the red line and copper in the blue line. So really illustrating the the sort of resilience in the case of, despite that, a slight dip at the beginning of June, but we're still looking at a market that's relatively well oriented in terms of oil. Copper, on the other hand, it continues to decline, right? Year to date, it's still, obviously, we're looking at good returns, but so again, some of the enthusiasm of the month of May, or the run-up April to May and then May onwards, some of that has definitely come down. So I think, when people start looking at commodities, they always like to look at relative value. And our next chart essentially shows that, where we're going to be looking at ratios of copper to oil, gold to oil. And to me, of course, people like to trade relative value, and so they'll try to capture that relative value by looking at these kind of ratios. And it's quite interesting because both copper and gold is a ratio to Brent in this case, and now we're looking at the futures prices rather than the mono indices. But you have such a close tracking in terms of how these ratios evolved. So I think there's a lot to do with again the context of each of these components. So for us, we're looking at an oil outlook that's still relatively positive. OPEC managing expectations in terms of not oversupplying the market. People are still relatively confident in terms of seasonal upturn in oil demand. And then on the other hand, well, we could think about whether or not, again, in the context of the economic indicators we were talking about. So yes, there's China, we mentioned that. We saw Eurozone manufacturing struggling. Yes, we had a reversal, but that was in May in terms of IP in the US. Yeah. The ISM number, the survey number, not looking so good. So chances are that, if you have more downward pressure on copper, and the LME 3-month contract is now back sub $10,000 a ton, and you have that resilience in oil, well, these ratios are going to continue to decline. So for someone looking at the commodity market, it may be an interesting trade to be positioned long oil versus metals, and whether it's copper or gold. I mean, gold's an interesting one because it did pick up alongside Bitcoin, that value seems to have stabilized. The question is whether or not it's going to remain up there. So when you look at gold and you look at the demand for gold, people tend to look at physically backed ETFs, and the amount of money that has gone into those and the amount of gold that's actually held hasn't really increased that much recently. So that you don't seem to see that investor impetus in gold rising, or at least not rising forcibly. And the other interesting news around gold was, and this shapes market expectations, is central bank purchases. So the Central Bank of China was actually buying quite heavily. And the fact that it stopped buying could be a little bit of a downward sentiment for gold. So we think these are interesting relative value trades in the commodity space where you have that optimism and enthusiasm for oil to keep it up, if not push it a little bit higher, and downward pressures on either base metals or precious metals. So I could expect those ratios to keep trending downwards.
I think especially if you're more skeptical of the IEA's forecast and you think that there's not going to be as big a surplus into the future, if you're more in line with sort of OPEC's thinking about how demand's going to keep growing a bit more, definitely. I can imagine that continuing to shape sort of positive market sentiment.
It's certainly, I think for oil, there's a broad consensus, at least what non-OPEC supply is going to do. Obviously, people debate what OPEC is going to do, but since their last meeting, they seem to have convinced the market that they will keep oil off the market, at least until Q3. And then we come to what really moves the needle in terms of the oil market balance. And as you rightly say, you have this divide between the IEA's view on oil demand growth this year, barely, if any, reaching the 1 million barrel a day mark year on year for 2024. And OPEC is looking at twice that amount at 2.25, I think, year on year for 2024. So if you are leaning more on the OPEC camp of views, and that certainly reinforces the possibility here for at least a denominator of these ratios to remain strong and have the overall ratio come off a little bit.
No, absolutely. And just as a final point, so what's being released this week? As of this morning, so we had the Germany's IFO surveys from June, which
we talked about.
Yep, Harry spoke about. We also have the US Dallas Fed Manufacturing Activity Index for June. On Tuesday, we have the US Conference Board Consumer Sentiment for June, as well as the Richmond Fed Manufacturing Index for June. On Wednesday, we have the US new home sales data for May and France consumer sentiment for June. On Thursday, we have the third estimate for the US's Q1 GDP data, which I believe is expected to be 1.3%.
Yeah, ish.
Somewhere around there. We have also the US's initial jobless claims, durable goods orders, May preliminary readings, and Italian consumer sentiment. And on Friday, we have the University of Michigan's sentiment survey for June, and then France and Italy's CPI data for June, so inflation for June, along with Japanese industrial production and UK Q1 GDP final.
It's quite a set of data, and I think what's certainly going to be interesting in the context of pricing ECB rate cuts is inflation readings out of France and Italy. I think that's key. Yes. Consumer sentiment, as we were talking about earlier, in the U.S., which was a sort of mirror image of China, where we had industrial production picking up, but retail sales just barely progressing. The Conference Board Consumer Sentiment Index is going to be a one to watch, I would think. Then we're at new home sales, following up on the building permits and new starts. But I think overarching all of this week of data ahead of us is politics. It's going to be very interesting to see how market sentiment evolves following the first presidential debate between the incumbent President Joe Biden and the previous president Donald Trump. I think people will definitely have their eyes on that, and in terms of how they, at least for the U.S. economy, see things evolving. And then on the other hand, you were mentioning the first round of French elections is scheduled for the weekend on the 30th of June. So that's certainly another element in the political picture. So between the data and the overarching political context, I think we're in for obviously a lot of uncertainty as to how the markets are going to be reacting here.
And we've even got the treat next week of the UK election, and then obviously the second round of the French election. But from the data, obviously, the French election is the one that's much more up for debate, much more uncertain around who's going to get how many seats and who's going to be the largest party.
Definitely.
But yeah.
That concludes our Monday macro.
It certainly does. Thank you.
Thank you.